Hello and welcome to my next vlog. I've had a fantastic question in from Jez and it's all about raising finance for deals. So if any of you are struggling to buy your first buy-to-let, or you're wanting to increase your portfolio or get into development projects and your own funds are running a little low, then this vlog is for you. So let me start off with Jez's question. Dear WPW team, thanks for the email and the opportunity to ask a question. Mine is this. What is the easiest stroke best stroke cheapest way to raise funds for a deposit to enlarge my buy-to-let portfolio? I've recently bought 2 properties from the proceeds from the sale of one in London, but I don't relish the idea of waiting for the equity to increase sufficiently to repeat this. Other people manage to enlarge their portfolios. How do they achieve this? Many thanks, Jez Nicholson. So thank you for your question, Jez, and hopefully the answer will help a number of people. So before I go into any of the suggestions I'm going to make, I'm going to caveat it by saying be extremely cautious about borrowing funds for a deposit, because essentially you have to take account of the cost of the borrowing in your calculations on any deal analysis that you do. So make sure that you are really up to speed with how much it's going to cost you and how much profit you're going to make and whether you can pay it back in time and in the context that you've actually borrowed it. So essentially, when I first started, one of the easiest and sort of best and cheapest ways that I could raise finance way back when was with a student loan. Now, you may not be in that position necessarily, but looking into loans or raising your credit card limit and raising funds out of credit cards, particularly for refurbs, actually is pretty good for that. But you can raise money out of credit cards at very, very low interest rates if you strike the right deal and you get the right type of credit card. It can take a while, but it is worth it. I was getting rates at 0% on credit cards and under 2% on my student loan. So that was definitely the cheapest and the best way for us to start. Now, bearing in mind, if you look around for the types of loans and credit card balances that you could achieve for your personal situation, then that's the first protocol. Just find out what you can raise. Then speak to a really good broker with regards to how long you're going to need to hold that money in an account, so that the lenders are not going to question where it's come from as much. Because if you have held money in an account from money that you've borrowed for less than 2 or 3 months, then the lenders are going to be quite unsure and say, well, you've just borrowed this money from over here and it's going to be hard for me to get a lender to accept lending you a large proportion of this property fund, based on the fact that it's going to be 100% geared, because they're going to see that borrowing is going to be going down as a deposit. So you need to speak to a good broker to find out how you can structure that particularly, so that there will be either no questions or very few questions asked about where that deposit's come from, as long as it's been in your account for over 3 months, typically speaking. So work with your broker on that. The same goes with raising finance from family or friends. So that's another good way. If you've got good relationships with family or friend members who have got some money that they're happy for you to work with, and that all depends on your relationship with them, on sort of the type of deal you can strike with them. And then the same goes for that type of scenario. Make sure that you check with your broker how that could work. So it basically needs to work all round. So if you are raising money from friends and family, that would be deemed as a joint venture, and there are other ways of forming joint venture partnerships as well with other people that you might go to a networking event, start talking to people that way. But you must be cautious, because there is a policy statement 13/3 from the FCA, which has come into action a couple of years ago, stating how you deal with joint venture partnerships and relationships. Very, very different if you're wanting to profit share versus taking out a loan agreement. So profit share is mainly frowned upon, apart from a few exceptions, and loan agreements are typically the way to go when you're working with joint venture partners. And of course you can agree whatever interest rate you want with your JV partner. So it could cost you as little as 4% per annum, or it could cost you as much as 10 to 12%, depending on the person that you're talking to. So that's a pretty good avenue for you to explore. in terms of your competency and ability to prove yourself, I would suggest that you start small, on a small project, build up your confidence levels in terms of working with other people's money, and always ideally be able to add value to the property, so you're locking in your profit and you can make the payments to your whoever you've borrowed the money from on time and on budget, and so that you are making money out of the deal as well, because there's no point borrowing money that you're going to stress about, basically. So adding value is absolutely crucial, and it's something that I will be talking about more in a few weeks to come. So basically, the more credibility you can build, the more investable you become, and so then other avenues of revenue, of finances start to open up to you. Angel finance, bridging finance, although bridging finance you can use from the off, it's very expensive, and typically speaking isn't the whole portion of the purchase price. You can, in some respects, use bridging finance to offset against any equity that you have in your other properties. So that is an avenue that you could look at. But again, it's pretty expensive and pretty bespoke. Now, if any of these suggestions you will need a bit more help on, then please feel free to get in touch with me, Jez, and I can help you to navigate your way through, and perhaps put a session in or something like that to help you to really to hone your craft in this respect, because it's not straightforward. It is quite a big subject, but hopefully that's given you enough of an idea, an understanding of some of the avenues that you can go down to raise finance. Because yes, you're absolutely right, there are people do and can build their portfolios with other people's money. It's done all the time. It's just a question of knowing how to do it. So there's a little bit of an insight for you there. Hope it's helped. Any further comments or questions, pop them in the comments box below. Hope you've liked it, and I will see you again soon. Thanks for listening.